us at Landmark Space for the sclr event this evening. We've got a couple of speakers that will hopefully give you some insightful information. So I'm Richard from Landmark Space. We specialise in flexible working solutions. So we've got private offices, co-working spaces, virtual addresses, you name it, we probably do it. So if there's anything I can help with, let me know, and I'll hand over to Patricia to get things started.
Maybe.
Over to you now.
Thank you very much. And there will be some wine and drinks later on. It's just that we usually start with water. My name is Pirityi Makhmutova. I'm a founder of sclr Labs. Probably half of the room already knows me, or even more. So how do we do that? That's a good question. Oh. Okay, well, first of all, thank you for coming on such a beautiful day, because I know that when the sun shines in London, no one wants to be in the room. But you guys deserve a huge thank you and a round of applause for that. So I'm really happy to see so many faces. We have a fantastic panel, and I think a great topic to talk about, how to go from the seed to Series A, which is usually quite challenging for many startups, and I know that it's not always so easy. So we are looking to look at different aspects, what to do. Maybe actually venture funding might not be the best idea for you, so lots of different angles that we can discuss with a great panel, and I will not be talking too much about the panel. I will introduce our moderator, Greig, who is the head of growth at AccuraCast. He's got 20 years of experience working with growth stage companies, and he has had 2 exits, and he's been a board advisor and has worked with NATO and Obama administration. So quite an impressive experience. Greig, over to you to introduce the panel, and I won't take the stage anymore.
All right, thank you. Do we need this? Do we need this? Do we need this?
I don't know that it's having a massive impact.
It's not really, is it? It's only a small.
Oh, I didn't switch it on.
All right. Well, thank you very much for allowing me to come and join you. This is very, very exciting. So, I don't really know how to introduce the panelists. I think they'll be better introducing themselves. Do we want to get them up on stage?
Absolutely.
And then let them do a bit of an elevator pitch? Because I'm sure some of you guys that are going to be raising your Series A soon, that's the #1 question you're going to be asked. What's your elevator pitch? What's the one thing that stands out? What's your USP? So why don't we get all of the panelists up on stage and they can introduce themselves. Give them a little... Sorry, Mariam, sorry. So I think we've got an hour of questions on getting from seed to Series A with some well-versed, experienced guys and ladies. So before we dive in, let's kick off with intros, as we said. So give us your elevator pitch and tell us what motivates you to help founders at this stage. Mariam, would you like to go first?
Yeah, absolutely. Hi everyone. My name is Mariam. I'm an investment associate at InterSystems Venture Fund. We are a CVC, and corporate VCs work slightly differently in the sense that we have a single LP and we pursue a strategic fit. Before that, I used to work for an investment infrastructure backed by the London Stock Exchange, and my whole purpose of leaving was to streamline fundraising for founders. Before that, I used to work in startups, so I kind of so far as went through this full cycle of being very hands-on, fundraising for pre-seed biotech startup, to then sort of covering all the different sectors, and now in terms of the industries, we are health tech, fintech, AI, and supply chain from pre-seed to Series A. In terms of the motivation, again, because I've done many different roles, and you do pretty much everything when you work in a small company and you're driven by one single purpose. So it's just really exciting to be hands-on with the founders. And then when it comes to fundraising, like that's the part that you want to get done as quickly as possible so that founders can grow and actually build and do the actual work. So I feel like this is the area where you can bring a lot of impact. And because actually we provide non-dilutive funding first, before we take equity investment, again, that's for me an opportunity to really work with founders in finding that strategic fit, being sort of more of a helper than just we're going to scrutinize and analyze and then make a decision, if that makes sense.
That's awesome. I think there'll be a beeline to you afterwards, because that sounds fantastic. Ciaran, you're up next. Elevator pitch. Why do you want to help founders at this stage?
Sure. So my name is Ciaran, co-founder of Swoop. So what we offer is a platform for businesses and financial advisors to access a kind of myriad of financial products, from lending, investment, grants, and kind of various banking products. Launched the business about 7 years ago. We're a bit of a walking case study of our own platform. I've raised kind of over 25 million ourselves to date, so hopefully we can give some experience into that. We now have about 250,000 businesses on the platform across six different markets that we operate within. From a motivation point of view, we see founders at a seed stage as kind of an ideal customer type. Selfishly, from a Swoop perspective, we're trying to build long-term relationships with the business owners that we work with. And founders at seed stage are pretty ripe for financial products in that, yes, you're looking for a seed, but you're also trying to get first bank account, deposit account, insurance product. Might move you out of the equity mix into the debt mix. So yeah, selfishly, you're our target audience.
Soma, last but not least, please.
Well, it's a difficult, big challenge to introduce yourself last. I consider myself a really lucky chap because I have experience on both sides of the coin. Once I was an operator, scaled up a company during COVID. After we made a sales, 430 under 30, a bit of everything, and after 4.5 years, I was in venture capital. And what I'm doing right now is a little bit the blend of those two experiences, because I'm always open about my failures as an ex-VC. Almost 80% of the time, when we failed with an investment, when we failed with a company, it always goes down to the people, not by the chance, which I'm going to tell you multi-million times, so please get used to it tonight. Investors invest in people. And this is what I'm doing after my venture capital years. I co-founded ETA Technologies, the first ever psychometric AI, which is analyzing the most important element, the founders, the team. Our analytics is providing comprehensive and quantified overview for investors so they can see that, look, this is a bunch of alchemists turning money into gold, and if not so much, what needs to be changed. My motivation to be here because when after my operator years, I joined the VC, I had a sudden realization, like those light bulb cartoonish moments, that how much the two sides of the coin, VCs and founders, they misunderstand each other. And as such, it's a mission of mine just to provide clarity that what people think is important in fundraising and what is really important from venture capital in fundraising. Sadly, this is a big secret, and I do hope that tonight we all together are going to unpack it and provide you with something that you can use to complete your rounds.
Lovely. Thank you so much. So we're going to kick off. We've got a few questions here. The venture world has been a pretty strange one over the last 3 to 5 years, and Trump's tariffs haven't made it any easier, have they? Especially for some of the guys that we've been talking to about manufacturing in the grid. Obviously, that doesn't represent everyone selling into the States, but the tariffs are pretty kind of all-encompassing, aren't they? They're pretty painful for anyone looking to export out into the States. But given that it has a massive impact on fundraising strategies, how should startups sort of moderate their strategies to account for increased investor caution and market volatility? So you can take it out of the Trump kind of the Trump tariffs and make it more broadly. How should fundraising strategies change for market volatility? And I'll give that one to you, Mariam, to start.
Sure, thank you. Yeah, I feel like if you think about VC as an asset class, it's very new. It emerged in late 60s and it has undergone several cycles of change. It used to be one big single check up front for about 50-40% of the company. Then they learned that it's more efficient to divide it in single stages. So VC as an asset class is very dynamic. It is constantly changing, and hence the rules of the game are changing as well. If you were raising pre-seed with a pitch deck before, now you are pretty much expected to have a working MVP, right? For the seed stage, you're like, okay, I'm gonna go for the product market fit. Now when you're raising seed, you're pretty much raising, the expectation is to raise to solidify that product market fit, i.e. you should be a revenue generator or having early traction. So I feel like this is the dynamic that we are observing at the moment, and whether it be Trump's tariffs or anything else, in terms of the macro picture, fundraising takes longer. It used to be 3-4 months. Now we are observing that it takes even longer. Oh, by the way, can you guys show like sort of a raise of hands who has raised seed already and are looking to raise Series A? Who has raised pre-seed before them? Okay. Founders in the room? Okay, great. So, well, you will be raising at some point, right? So, it takes longer, and you build this relationship from the early start, because that's the main feature of VC, right? It's not a capital market where data is available in the open, where you can analyze anything. And as Soma rightly pointed out, investors invest in people, so you gotta build those relationships. I've got a couple of other points, but I think that's it on next. Maybe you can have a discussion.
That's a very fair point, isn't it? The cycle has switched a little bit. I remember raising, I've got a question about this later, I remember raising pre-seed, and it was like, what's your scale? Like, what's your market projection for users? Yeah, just using the platform. We didn't even have to be revenue generating, but now you're raising and you need to be revenue generating. I butchered the question, so I'll reiterate it again. So how do startups need to account for market volatility? That's it, that's what I should have said. So Ciaran, please.
Yeah. Obviously, I would say it depends if you're trading or not trading. If you're currently trading and there's a lot of volatility, certain things, if you've got international exposure, currencies comes into situation a lot. So I would get familiar with things like hedging. So that's kind of essentially where if you're dealing between sterling and dollar, sterling and euro, that you're locking in a rate over a protracted period of time, so that you know no matter what craziness is going on there, you've locked in the same rate, so it doesn't affect your supply chain, and you can kind of be more proactive about your cash flow management. So I think that can be important. But if you're going in the earlier stage, particularly if there's market volatility and your proposition is multi-market, I think going back to traditional pitch deck and looking at the TAM, SOM model of just really, because like a lot of like a VC analysis will start there in terms of your market sizing, and I suppose you want to come up with an economic argument that you can work within a certain jurisdiction that allows you to get to a certain level of cash flow or growth before you actually need to think about the biggest picture, which might be some super duper big target market. But if you can show you've got a relatively healthy serviceable market that you can go after, and you can talk into that at an economic level, then that's super important as well. So I just make sure that you can articulate that in your forecast model. But if you are trading, I think if you've got import-export exposure, think certain things like locking in currency rate seems like a basic one that would really help with a cash flow scenario.
Thank you, Ciaran.
So what we have heard, two extremely practical and brilliant advice, allow me to have a step back and be a little bit more philosophical, if you don't mind, because I can assure you we are going somewhere. So last night I had a very good dinner with an old friend who we invested together in the Valley, and whenever those guys are actually coming to the UK, you know, everybody's surrounding them and like, oh, tell me what's the future, tell me how the Valley looks like nowadays. And what he told me was kind of shocking, but extremely relevant to this point. As Silicon Valley at the moment sees that what is about to happen in startup ecosystems in the next 5 years, and sit back, relax, enjoy your journey, but there are going to be two types of startups: deep tech and non-deep tech. The deep tech where you are bulletproof because of your technology, aka 2% of the startups we speak about just proportionally, you are providing the infrastructure for all the 98%. Now the other 98%, which is the non-deep tech, in which case, with a fair exaggeration, you are not bulletproof from the technological standpoint because your technology can be recreated by AI, once again highlighting the next 5 years, like this. AKA, you need to be bulletproof from a commercial standpoint. People are not going to choose you because, oh my God, it's such a fascinating technology. People are going to choose you because your brand is so strong, because you have a reputation in the industry, because all my friends are using you. And my philosophical point here that show your investors you are bulletproof. If you are a heavy, deep tech technological company, show them that your technology is bulletproof and it's going to be the infrastructure, the gold standard in the next 5 to 10 years. If you're not in this 2% but in the other 98%, focus on being bulletproof on the commercial side. And if you are medtech, biotech, I understand how difficult it is, but my best advice for you in general terms, that just try to come up with a quantitative and qualitative argument why you are bulletproof. And of course, the elephant in the room, what if you are manufacturing? Now, that's a complete piece of cake. I had so many calls when people asking me, because we, back in 2022, we were investing in hardware, we were investing in manufacturing. I think the most important to show your investors that nobody knows what's about to happen, whether the tariffs are going up, down, or in circles, as in the Wolf of Wall Street, but show them that you are capable of doing scenario planning. This is the most important, because we don't know what's about to happen, but if you show great flexibility, that's already a win.
I think that was very practical.
I love that. Yeah.
I tried to be philosophical. That was my major at uni. So.
No, I love that. And actually that brings us on to the next question. So I touched on this before, and I think, Mariam, you touched on this when you were talking about the stages of raising. So I last raised in a time where value was linked to scale. So how many users you have. They don't even have to be paying users. You just need to have more users than the next guy. But investors are more risk averse now, and they need more tangible growth, right? So they scrutinize ARR, they look at the CAC, they look at LTV. All of that stuff is now part of the course, which it kind of never used to be. So what do you believe, and I'm going to start with you, Ciaran, on this one. What do you believe are the financial metrics that Series A investors prioritize now? And how can founders effectively present these metrics to potential investors? I think Soma started down this track, but I think, Ciaran, it'd be good to follow on.
Yeah, I think it's probably the next level of depth down on that user side of things. So yeah, they're going to be interested in terms of how much acquire that user and what's the lifetime value of that user. But you kind of want to wash it through from the dawn of time. So all of those businesses or customers, whether it's B2C consumers or businesses that have come into your business, what's happened to them since you've made that sale. So this kind of getting into cohort analysis is really, really important. So depending how long or old your business is, you might want to do cohort analysis on a monthly basis, or you might run cohort analysis on an annual basis. But what you're showing is when you make a sale to a customer, what happens next? Is that a sale over, or is it repeatability? And if it's repeatability, is it an annualized basis? Is there an upsell opportunity on there? Do they take multiple products? And the more you can talk into the user behavior of the customer behavior of that and what happens to them, that will get them kind of more and more excited. And the other aspect as well is just at the very beginning is the channels in which you use to get those customers in. And so what's the cost of acquiring a funded customer? Okay, broadly speaking, there's going to be a CAC blended, but actually I'm interested to know, how do you go and get those customers? Do you have a bunch of human beings going out and corralling them into the business, or is it driven by SEO? Is it driven by paid activity? Is it driven by partnerships? And they're analyzing to see, is this an efficient way to do it? Is it a scalable way to do it? So if you can articulate, not only can I acquire a customer, but I can do it in a cost-effective way, in a cost-effective, scalable way, they're the kind of grey boxes. And then when they do come into the house, what happens to them, how often do they repeat, how do they churn. So I would say they're the kind of metrics that I would be focused in on at a Series A stage. That's going to hopefully kind of hit you like in the top grade percentile, which would then unlock the funding.
Love that forecasting 101. Perfect, Ciaran. Love that. Soma, over to you.
Well, you kind of stole the show, mate. So I need to come up with something unique. I would tell you that there are two metrics which you need to absolutely focus, and there is a bonus here. Churn and customer retention. This is what you have heard from a certain mathematical standpoint. Let me tell you it from like a really simple logical standpoint. We live in almost like a recession. And there is a recession, there is desperation. Best way to demonstrate it that there are so many of those hiring companies growing like mushroom who are offering for the fresh graduates that, hey, pay me £100 and I'm gonna put you in whatever graduate scheme. What's really interesting here that potentially making a sale and making money is easier than ever, once again, because there is desperation on the market. What's interesting that, you know, if you charge them on a monthly basis and you do not provide, if you do not deliver, those guys are going to leave you. And what VCs are looking for that, okay, I understand that you have a bunch of cheeky car salesmen, you know, under the engine, you can do the sales, can you deliver? And that's why churn and retention are extremely important, because in the long run you're going to survive if you are able to offer not just a temporary, oh hey, I'm going to get you a job, but you really get this job. And another one which I would highlight, back when I was VC, there was a really funny saying which our portfolio manager taught us, and for months I had no idea what he was talking about, but it kind of makes sense now. Show me your unit economics, because if I'm going to be the one figuring out for you, you are not going to be happy, I'm not going to be happy. So with many of the AI startups, actually revenue is important, but there is something which is 10 times more important. Show me that maybe you are not the most profitable, EBITDA positive, whatever business around. That's all right. Show me what you are the best at. Many of the AI startups are around not to, you know, make money out of the monthly subscriptions, the tiny fraction compared to the real goldmine opportunity, which is the data. But as an investor, you know, if you leave it to me to figure it out, I'm not going to be happy, and trust me, I'm not going to figure it out. I'm going to say next time. So show me your unique unit economics, that what are the KPIs for your business, and allow me to be the judge based on the numbers you provide. Don't be lazy, do your homework, give me the numbers. That's possibly my best advice.
Lovely, love it. So finally, Mariam, over to you.
Probably let me summarize that the most important thing is the sort of quality revenue growth, as Ciaran pointed out, that you need to go deeper in your analysis, but also one factor that I think we will talk about is sort of the team, right? Because Series A, and although some of you may be a bit earlier stage, but Series A is still an early stage. Sort of pre-seed to Series A is early stage, and Series B onwards is what is considered growth stage. So actually no one expects you to be profitable. It's good that you are, but you need to know the assumptions that will get you there. What you ought to have is the strong core team that has lived through pre-seed and seed levels, and you need to show, and this is more on the qualitative side, that you need to show that you are able to build a scalable team further on, you know, because you will be presenting your hiring plans, your organizational charts, and you need to show that with the resources that you've had up to Series A, you are able to retain not only customers but people as well, because these are going to be supporting you further on, and you probably motivated them with equity as well. And for example, if that all vested and they left, that also communicates something to investors. So it is something that you need to be thinking from basically the foundation of starting the company, you know.
Yeah, we've all made some difficult hiring decisions, some challenging hiring decisions, right? We've all made the wrong choices, and we've all ended up having to leave someone with vested equity.
Oh, yeah, that's
in their
another
pocket,
tool.
right? We've all done it. Given you raised the increasing importance of team dynamics in investment decisions, how can founders assess and improve their team's performance and cohesion? Ciaran, we'll start with you.
That's a tough question.
So let's say not make it even tougher, but
Yeah.
from the hiring
Yes.
hiring stage through to kind of ongoing performance.
Yeah.
From vetting to ongoing
Yeah.
performance check-ins.
Yeah, and I would say, like, Jesus, we are so far off mastering any of this, and I feel like it's just like a constant, every day go back to school and you're trying to learn a little bit more when it comes, because people are the most crucial thing when it comes to any business, and as you go through various different stages, I often maybe crudely compare it to the football league, whereby you can only afford Conference League players at the beginning, and then you can afford League 2, 1.
100%.
And naturally, you might be able to get a championship or a League One player in the beginning if they're willing to take up some equity. But in the same vein, if you're trying to bring that squad up to the Premier League, you absolutely aren't going to be playing with the same players that you were playing there. So you need to understand that there's some people who have a finite capability within the team if you're on this growth pathway. So that's just something always to be cognizant of, and in terms of how you, and when you bring them and how you shape their role, because yes, you might want to bring them in the beginning as a League 2 player, but you kind of want to give them the pathway to Premier League.
Yeah.
You know that's not going to happen. But the biggest thing that I feel that has helped us is process around onboarding. So the more time you spend up front, even before they come into the building, prepping and thinking about it as they come into that role, and do spend more time than you think you need to do, spending time across teams, kind of like forcing it a little bit in terms of how you work amongst teams, spending time in systems, because while you might get an off-the-shelf piece of technology, you're going to have configured it in your own way, it's going to have your own acronyms, there's going to be all these stuff that seems normal to you, but it's so alienating to someone else, and because you're so entrenched in it, it seems so normalized. So the biggest thing I think around the people piece, no matter what stage you're at, is to really spend a lot of time thinking about that process of onboarding a person into that role, so they can really, what are those expectations, what do you expect them to get out of it, how quickly can you ramp up, and actually spending a lot of that time at the beginning will help that ramp. And I think this is an obvious one, but everything is better for me anyway. Maybe it's subjective, but it's metric orientated. Not every person is in sales, but absolutely, whether it's in marketing or in engineering or product, there's plenty of metrics that you can work with, and people will have different metric systems they use around human capital in organizations, but I think it's pretty imperative to get it in as quickly as possible, and to give them individual ones that tie into an overall, because it becomes very clear 30, 60, 90 if you're working, if both parties are getting something out of it, and it makes decisions much easier if it's clear it's not working out, so you can move on from it. But I would say having a metrics-based system for people and companies, and then really spending time on that onboarding piece.
That's such a big one. The accountability is paramount, because when you are early stage, you don't have the cash, you're bringing them on under equity, they're almost kind of doing you a favour.
Yeah.
And unfortunately, you can feel beholden to them, because you feel like, oh, they're really helping me out here. Oh, they're part of the team. Oh, they had a bit of credibility. Oh, they were at this business before. Oh, I don't want to piss them off. But actually, having that metrics calculator, KPIs, making them accountable makes it very easy for you to say out the door and never give them equity up front. Ciaran, question to you.
Sure.
Do you want me to repeat it?
Soma.
What did I say?
Ciaran.
Sorry.
If you want to start again, I don't know, man.
Sorry.
No worries at all. I have 3 points here, and I'm not going to be philosophical, I will be really practical. Number 1, never hire for skills, hire for attitude. Nowadays, everything or most of the stuff is done by AI. You don't need, so good in programming, so good in sales, but he or she is an asshole. Excuse my French. Do not hire this person. Hire someone who has 200% enthusiasm, 300% passion for what you're doing, and teach this person, because that's what the real work what you need to do. Number two, be well aware what is your position. When you are in Series A, you do not sell, you do not operate. What you do, you serve. You are the most important and the most humble servant of your company. What you do, you provide an infrastructure, you provide an environment where people are able to flourish. Your job is to open up everybody, to make sure that the tech department is not just sitting in that corner working on whatever features and functions. Meanwhile, sales is like banging and banging and banging and selling and selling and selling, but those people communicate with each other. Create an environment which is open, everybody is partner, and everybody feels listened and heard. And last but not least, possibly the most important, kill the drama and kill the politics. Don't worry, it will come. Inevitably, it will come. But your job is to minimize the friction. Make sure that people are invested. Make sure people have an opportunity to shine, to work, to learn. As an investor, I invest my money into you as a managing team. Your primary investment should be your people. Train them, teach them, and make sure that they have everything given to do a job, because working in a startup, as we said, it's not a 9 to 5. You expect really serious commitment. A 9 to 9, sometimes a 9 to 5, but from 9 a.m. until like 5 a.m. In order to do this, everything else in the organization must be properly in place.
Sorry, you just took me back to a place there where you expect other people who you give an equity to care as much as you do. And I tell this to people all the time, like, no one will care as much about your business as you do. So no matter how much equity you give them, they will not pick up the call at 1 in the morning when you're having a drama. Or a hissy fit, or whatever it might be in my case. Mariam, question to you.
Let me go back to the time when I worked for the startup, and I actually cared for the startup, I think, as much as the rest of the team, although I was not the founder. And yes, I had an option, but I think, sort of, without naming names, but 2 examples. So in one company, the CEO was super quick, sharp, very driven, and they gave me anxiety. And it was really difficult to keep up, and I didn't really feel like I was appreciated, professionally. In the other company, the whole purpose of the CEO, and it was 3 co-founders, feel sorry for solo founders right now, but 3 co-founders, and they had a very clear split in their roles, and CEO was strategy, fundraising, and keeping the team together. And I was part of the family, and that's how the team, although I was just, out of the university, one of my first jobs, but it was super, super exciting to be part of that team, and all the credits go to CEO. So I think for all those who are building the team, these people come to work for the startup because yes, they want this to be something big, but also they want to be quite horizontal, and you really need to care for that. And I think some founders really underestimate sort of the importance of actually building the team rather than the product, especially that investors invest in the team in the early stage, if that makes sense. But I happen to be challenged sometimes.
No, that's really good advice. We were talking in the break about how important it is for a CEO. I know that we've changed the dynamic of this question slightly, but I think it's important as we've got a ton of founders in the room, how important it is for a CEO. We were saying there's no job description for a CEO, right? Because you have to be transparent to a point. You have to hold in to yourself quite a lot of the stuff that's going on in the background, because as soon as you start telling your team, they might run for the hills, or they might go, I don't want any more of this. I've made the mistake of being too transparent in the past. And I've worked with a lot of narcissistic, egocentric, control freaks in my time, and when I've started my own things, I've tried very hard to build the team, make them feel warm and fuzzy and cozy. There is a very fine line there between being their friends and running the business and you being family and stuff.
That's true as well.
Maybe we should talk about that after, because then that plays on the dynamics. How do you keep them engaged? How do you ensure they're hitting their KPIs? and actually distance yourself enough that they're not the ones keeping you going. It's better never start a business with your friends. Right? Never, ever. It's a terrible idea. I've done it. It's bad, so bad. So we're going to flip that question. So from, in exactly to your point, Mariam, and I think you guys all sort of said that investors invest in the people. So how can investors utilize strategies or technology to help support that gut feeling? So if any investors in the room, you'll often go, I like the business model, it's okay, revenue's good, but I like him or her, there's a spark there. How can they use methodologies or technologies to validate that gut feeling? And that goes to show you.
It's pretty much my specialty. To sit
Funny
back,
You were waiting.
sit back, relax, 45 minutes. Yes, which is coming. Just kidding, just kidding. So let me get back to my years, which was a great frustration for me, because in venture capital, I think there's a great misunderstanding about the individual contribution. Because A, there are a lot of VCs, angels, syndicates, so on and so forth, who are really chasing the individual genius. I want to invest the next Steve Jobs, possibly. I've heard it many times. The reality is that none of those people, without the team surrounding them, without the team, quite frankly, tolerating them, would be Steve Jobs, Bill Gates, Elon Musk, you name it. So many people think that what we need to do is just putting the Lego pieces together. I need a CTO who's ex-Google. I need a CEO who's ex-McKinsey. I need a CEO who's ex-Amazon, and we all will be fine. Just give them $2 million. Guess what? The smarter the people are, higher the ego, aka very simple calculus, lower the probability that those people actually can work together. What you should look for, and once again, I don't want to do sales pitch here, that actually talking to the full team, analyzing their dynamics, analyzing their chemistry with a more academic term, how the different entrepreneurial personas are able to work together. It was a big headache for me, and I'm really open about my failures. I lost so much money because my judgment was clouded by, oh my God, those guys are growing 50% months and months. This is amazing. They are making so much money. Everybody loves them. They extended to the US. The team is damn. They shall figure it out. Guess what? All the money went down to the toilet. Put people first, and basically what I want to say that back in my days there was no tool, methodology, formula, nothing. It was finger in the air maths. It was background check, and individually those guys looked amazing. Put them together and they blew up. And that's why I created ETA technologies, or psychometric AI, to measure this extremely important layer and provide analytics both for founders and both for the investors. Best to my knowledge, there is no other tool, but I'm eager to discover if we have any direct competitors, because most of the time, if we speak about management DD, it's about background check, reference, and so on and so forth. There is no quantitative method to measure the team together. And that's exactly why I'm creating it.
Love that, and I'm sure if we've got any investors in the room, we'd love to get you up and find out a bit more about it. Mariam, question to you. How should investors, or how have you in the past been able to sort of assess a team?
I think it's an important point to try to talk to them at the same time to assess the team dynamics. For example, when I have sort of second, third conversation with the team, I start noticing things like they interrupt each other, or one co-founder starts rolling their eyes, and it looks a little bit funny in the sense that you said something wrong, right? Well, first of all, you can't make the first impression twice, and obviously you drop some of the founders, some of the companies at the very start, because that's how VC works. You need to reject quickly, but then those who attract the attention and catch the interest there, this is where you need to spend more time to actually make sure. And that's how you deal sort of with the deal flow that's coming in from different sources. With the team, to be honest, there's nothing there is no complicated stuff. We do background checks, we do references, especially we talk to clients and stuff, and you need to understand sort of basically you try to answer the question, do they have the ability to execute, right? Do they have a vision? Is someone more operational? Is someone more visionary? What's their dynamics? Do they have the right mix of skills in the team, in the core team, in order to fulfill the vision that they are selling to investors? Very basic, to be honest.
Thank you. Ciaran, what I really want is like a methodology you can walk me through, which is the ultimate, like, the golden standard for how you check, because I don't know if we've got any investors in the room, but I always get approached to invest in this or invest in that, and I would like something. Tell me what the thing is that I can look at the founders and go, right, and then I've got my tick boxes done.
Yeah, sadly I don't have any magic tricks in my locker to do such things. I think now I've not had the pleasure of testing out Soma's tool, so maybe Soma's tool is
that's
the,
it. That is it.
Is the answer.
Someone got 5% commission.
Yeah. But yeah, I think to what Mariam was saying, certainly I think it's spending time over multiple occasions. I know that's not the most efficient way of doing things, but you definitely see a shift in dynamic, and having more than just the founder there, I think, is important, because you then get a real sense of how the business operates. And we constantly are getting these people calling us, but there's plenty of businesses out there that will do secret surveys on things. I think they're called like the GLG, alpha sites, stuff like that. So if you have a bit of budget, you can get them to do your dirty work for you.
That's actually really leads us on to the next part, right? Because every truly great business was born out of passion that drives the founding team. But what kind of flipping it from how, as an investor, you look for the little spark inside potential founders, how as a founder can you craft a compelling growth narrative that aligns with investor expectations and market realities when shooting for Series A? Because it's not, oh, we've just started a business because of X. It's all, we've started a business and we're growing it and it's doing really well. And how do you keep that growth narrative, how do you keep that personal narrative alive so that investors are still sort of believing in you as a founder, in you as a leader? Sean.
I think, in order to answer this question, it's really important to highlight that why there is a mission/vision slide in every pitch deck. Because this is where it gets really handy. Building a company and raising pre-seed, that's like, okay, I built it from 0 to 1. In order to raise Series A, you need to build it from 1 to 10, which means you need to 10x everything. But still, you need to be consistent, unless you are pivoting, which is completely all right. But maybe you shouldn't mention it immediately in the meeting. Oh, by the way, we are pivoting, so don't give us the money. But you need to be consistent on your vision. You need to say that I'm here to change this problem, and we managed to demonstrate with the pre-seed money and with the seed money that the problem is there. Customers are paying for it. Now I'm going to turn this opportunity, what we found, into a complete gold mine. Mission, vision, and dedication. To be honest with you, I think surrounding with all that many AI tools and softwares, it's easier than ever, because what you need to really focus on, just demonstrate that, look, we did 0 to 1, now we're going to 10x, and we are going to be insanely productive. Many times, hiring is coming to the question, and back in my days, it was like, okay, you need to pay more attention to customer success because the churn is So you need to hire people, a 3 customer success guy who are going to do the job of like 9 people. Nowadays, you don't need to do this. You need to hire 1 guy who, with the surrounding technology, gonna do the work of like 15 people. So you need to be really sharp on technology, and you need to be really sharp on your hiring decision. Once again, finding the person who is not for the skills, but for the dedication, gonna do the investigation, the detective, the passion, wiring all those stuff together. Favorite saying ever from Isaac Asimov, that the answers are ready, you just need to ask the right question. And I think that this is the mentality what you need to demonstrate.
Love that. What was it? Vision, mission, dedication.
Vision, dedication.
I mean, you can show that from pre-seed throughout, but I think it becomes more apparent when you're going from seed to Series A, right? Because I produce this platform or this product or this thing because I have a personal connection to it. I've now grown it to X. As you said, there's a need for it, and now we're going to take it all the way. And now we've got these other revenue-generating channels to the business which we can leverage as well. Cool. Job's a good one. Mariam.
I think you used a very nice word, narrative, because that is not just quick facts. You need to build up the story so that the investor wants to find out more. You don't raise on the pitch deck. You use a pitch deck to get to the first meeting, right, to the first call, or for someone to refer you to another investor. So it needs to grab attention, but you don't need to display everything, because there needs to be motivation, like, ooh, I want to find out more. You need to build up this excitement, and it doesn't come from the very typical structure. The market is very big, the team is super capable, and we are unique. These are the basics. You need to have those. That's it. We're not discussing that. Everyone knows that. But you need to have something else in the deck that builds trust. And of course, it comes from the language. You need to use the right words. You need to practice the speech. A little bit off topic, but what I also face frequently is because I also lead some pitch competitions and sessions for another VC fund. You need to be prepared to have a 1-minute pitch, a 5-minute pitch, and a 10-minute pitch. And you cannot exceed those, because the number of times I had to interrupt the founder, and when I had to say to the call, if you can just give me a 5-minute pitch, and that means really 5 minutes because I have an agenda that we have to get through. We don't have enough time. I don't have enough time to answer questions, and therefore I'll have to end the meeting because I'll have another one, even if I like you. So it's really important to be prepared and respect sort of the time that you're allocated, because if you can deliver your story in the amount of time that you have, there will be another meeting, and you'll have an opportunity to talk more. And I think what distinguishes a seed deck from a Series A deck, and maybe it's a little bit subjective, but what I found particularly appealing for me is sort of late seed or Series A. They throw their achievements from the start. They have this summary slide where they say this much revenue, this is the growth, and you see the maturity. And that what distinguishes sort of earlier decks from later stage decks, if you like.
Ciaran. Nodding along vociferously there, completely agree with all those points. I think storytelling is so important, and it doesn't matter whether it's Series A, any stage, because if you put yourself in the investor's shoes, they are swamped, inundated with business and deck. So through no fault of their own, they're going to have very limited attention span. So if you can't capture it in a very quick fashion, it's just going to move to the end of the pile, and you have to kind of start from the point they don't really give a shit, they just want to make money, and so they don't really care about your business, and then you need to give them a reason to care. And so if you're throwing the kitchen sink at it, and it's just words and millions, like a Bible trying to get through this thing, then it's God, I've got an aversion to this thing, right? So you're just really not putting your best foot forward. And I also think, to what Mariam was saying, curiosity is so interesting. So to tell the story, because as you said, it's not about sealing the deal there and then. It's just getting the moment to get you in the room. So it doesn't have to be everything in there, but it has to be interesting and intriguing. And the other point about it is data and numbers are so important. So your big thing might be I've hit revenue, or I've hit profitability, or this level of retention, or my cohort's doing this. Stick at the bloody beginning. I don't want to wait till number 12 to get to that. I'm going for the business. I don't give a shit. Don't really care. Make me care. And if I'm an investor and I need to get return on my money, why do I care? I care because you're going to make my money go further. Yeah. So give me a reason for that. Briefly, upfront, give me curiosity. And you kind of have to make it a bit more cold-blooded, I think.
No, I completely agree. I've worked with incubators, I've worked with lots of startups, I've sat on the board, and still sit on the board of startups that are going from seed to Series A. And I have conversations with startups all the time, and they, no offence, anyone in the room, but they just waffle on about, I just want to know what you do, what your USP is. And that's just in conversation, it's not in pitch decks. In pitch decks, it's far, as you said, you need to be far colder, because you're seeing so many of them, you go through so many of them, and you need to be hit straight away with, oh, all right, now I'm intrigued, please tell me more. And I think that it's massively undervalued, this idea of inquiry. What did you call it? Sorry, what did you say? Interest, intrigue.
Curiosity.
Curiosity, sorry. Curiosity. The idea of curiosity. People want to put everything, and as you said, Mariam, everything in the kitchen sink in that deck, and I thought, you don't need it. You don't need it. Just your main achievements up front, or if you are pre-seed, why it's important to you, and why it's important to you. I was last at an incubator that had loads of health tech startups. Sorry, Mariam, you should say something.
Just one thing. I saw statistics somewhere, and I can actually tell you that it's true. 3 minutes is an average time that an investor will look at your deck.
That
When-
long? That long, really?
Well, to be honest, I
Jeez.
sometimes take less because, again, you need to reject quickly.
Yeah.
But then when you don't reject, this is where you spend the time. So even, for example, when you do a deck, ask someone to read it under a minute and ask them to tell you the main message that they get from the deck.
Yes.
Which points
Love
sort
that.
of stick out.
Which are the which are the main points that stick out, because they need to leave feeling like they've got something out of it, or feeling like they can see an opportunity. Showing us.
So just to add to these statistics, because back in my days, I mean, we're complete bastards from this perspective, and I apologize for that. But we had around 200 or 300 decks landing on our table every single day, and I remember I used my time as to a big chunk of coffee every single morning from 8 to 10 to review it. And once I did the maths, it was 38 seconds. And another point which I really would like.
First page.
Almost. I'm always saying that reviewing a pitch deck is like screening. And that's why it's so important. Another stuff which we mentioned a little bit, I just want to emphasize the structure. There are so many templates online, Sequoia, Anderson, Horowitz, blah blah blah, millions of them. They are marginally different. So when I review a deck in 38 seconds, I have a structure I'm looking for: problem, solution, market, finances, blah 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 blah. Really important. Do not try to be creative here. Do not try to reinvent the wheel, because if in 38 seconds I don't see that what's the problem, what's the solution, how big the market. If you start with like, let me tell you a beautiful fact, you know what I'm gonna say? Next.
But also probably, if you were doing it today, you would, instead of getting it, you'd start a prompt in ChatGPT going, upload this zip folder of 200.
I did that.
That's fair.
No,
That's
but you would go,
touche.
here's my prompt. The prompt is I need to know this, this, and this. And if it's not the prompt, it ain't getting picked up. Like that's realistically, but if I was doing, that's what I would be doing.
Yeah.
If I got a big 200, I go zip drive straight to ChatGPT, upload, write a prompt, give me the ones to focus on.
Just like the CVs, I have a good friend who told me the story because he was working in HR. That you know how many people are applying to the Harvard MBA? Can you guess this? 200,000.
200,000.
200,000. It's
For the
madness.
Harvard MBA.
The Harvard MBA. And just imagine the following: that a guy who's the head of the department just walking in HR and see that the HR lady is just playing and what's going on here? You should be like sorting out all those CVs. What the hell are you doing? Oh yeah, you are right. Huge chunks of CVs, picking one. Oh, that's excellent. We're gonna give him, the opportunity. The guy is completely in shock. What's going on here? I mean, you don't even take a look at all those others. Do you want to work with someone who's not lucky? and trust me, this is so true about all those systems that they're just screaming through like in a factory with the pitch decks, with the CVs, with the cover letters, everything. That's the reality we live in
I think you're actually moving us down another route there, which could be quite interesting. The whole idea of engineered serendipity in the investor space, but that leads us on to questions which I don't have. So maybe we'll come on to that another time. If anyone wants to put their hand up later for Q&A and ask about engineered serendipity, that would be quite exciting. Do we have time for 3 more questions? 3 more?
So we're like 10 minutes to 8. So let's say maybe 1 question and some questions from the audience.
Okay, I've got 3 questions here.
Okay, so let's do 2 questions.
2 questions.
Yeah.
A show of hands, who wants to know about valuations? Okay, hands down. Who wants to know about kinds of funding other than VC or angel, like crowdsourcing, debt funding, smart grants? Actually less, surprisingly. Okay, who wants to know about building relationships and keeping relationships ongoing with investors whilst also doing BAU? Okay, fine, let's do that one first. So fundraising is a full-time job, and while mission critical is not BAU, so what advice would you give to founders on building and maintaining investor relationships throughout the fundraising journey, whilst also obviously running their startup? Because it's a challenge to do both at the same time. Mariam.
I love newsletters from founders once a quarter. I think that
that's no good. Once a quarter is no good. That's no good. She's not being serious.
No, but I am being serious.
No, she's not being serious.
No, but if you get a nice newsletter with all the updates, to be honest, once a quarter isn't that long. Like, it's actually quite often, I would say. But then if you're not working on that deal, if you're nurturing a company and the founders obviously know it, because usually you get sent something like this once in 6 months. Obviously, if you're growing much faster and there are way too many more updates, of course you can do that more often. But honestly, it just feels like it's going to be a little bit too overwhelming. Okay. When I was fundraising with a startup, I would always try to find out what kind of events investors are going into, trying to catch them there, because you're going to pitch nights anyway.
Engineered serendipity. There you go. Beautiful, Mariam. Love it. Love it.
Yeah, so I would say these are the main 2 points, because even if you're, for example, even if an investor is not opening that email, they still see the notification, right? And we're all guilty for not reading all the emails, but still that draws attention, and still that builds trust and creates this notion that you are growing and you're achieving something. But obviously, if you can get the investor on the call, that's great. If you can arrange a meeting, you should definitely do that. My experience is obviously in person works better, but reports, I love reports, but maybe it's subjective.
That's what I do. I look after our investors in terms of relations and updates, so I do that once a quarter. And there are a couple of tools that are quite handy for me. So from a numbers perspective, we have this software on top of Xero called Join, and because we have businesses in 6 markets, I've got different P&Ls, so it allows me to bring everything together and have it in dashboards that I can aggregate or have it at a country level, and they're all in real time, so it makes it super easy for me to export. We normally as an organisation have quarterly meetings just to get everyone G'd up for the next 90 days, but in order to do that, often people will put decks and information together. So again, using our good friend ChatGPT, I'll selfishly aggregate some of that information and get it together, and then I'll have a standard kind of template that will go out, not quite a newsletter, but probably more of a deck that goes alongside the numbers with some commentary, and that goes out once a quarter.
The reason why I laughed and said that's because we're getting two similar opinions, which is quarterly. I treat fundraising and dealing with investors like I would having a client, and I treat them like a client. So I run a customer success kind of relationship with them. So I'd invite them out for coffee, I'd invite them out for drinks, I'd bill cash. Soma, please.
I'm going to be short here. Smart money, one word. So do not forget that investors, VCs, PE firms, they give you much more and just simply greening your pocket. We have strategic advice, we have mentorship, and we have a massive network of contact. It's important to update us what's going on, but I think it's even more important, it's a very nice way of keeping in touch. Give us a job. Tell us who you are looking for. When I was with my second fund, there was a guy I really liked, him, absolutely hyperactive, ADHD, classic texting founder. He was just calling us every single minute. Look, we really want to create a new enterprise line. I need contacts to Microsoft. But we are bombarding them with messages, emails, LinkedIn, so on and so forth. They're not replying. And it happened that from Exeter, one of my roommates, he was working at Microsoft exactly. So I was like, Mickey, hold on, let me give a call and you get a meeting tomorrow. So give us a job. Do not underestimate how much more we can provide than just the money. And that's why you're looking for money. You're looking for VC money. You're not getting money is easy. Ask your customers, ask your mommy, ask your daddy. But there is a specific reason why you want us on your board, because we can help a lot more. Utilize it. Don't forget that.
You're very true, and I was being flippant when I said you never know when you want money. It's their networks that you're tapping into, right? It's the wider community, their ecosystem that they're part of. Right, one more question. I can't remember if it was was it valuations? Is that
Valuation,
the one?
yeah.
Valuations is always a tricky one. Pre-seed, it's just finger in the air, whatever you want it to be. It doesn't matter because an angel's just going to go, no, I don't think so. I'm going to give you X for X and you're going to take it because there's no other choice. But when you get to Series A, things start getting a little bit more, they get a little bit more defined and you've got more room to maneuver. You can be quite creative, quite clever. So, Mariam, how do you value your seed to Series A startup? I did have in high growth businesses, fast growth businesses, but I'm just gonna, have you got like a methodology that you would use to pitch to investors to make sure that the founders get the best deal?
We don't do as much of it in the InterSystems CVC because we focus on the non-dilutive, and then when the equity part, it's usually do a SAFE or ASA. But what I've observed is, especially when you reach like a later stage, you just implement several methods and you cross-check how different these numbers are, like do DCF, scorecard, comparables, all three together. These are the methods for the valuations. See how they're different, because if for example, well, DCF is challenging unless you have like a lot of trading, like you need to have those numbers. So if you can't do the DCF, like you just need to you need to persuade the investor that you know what you're worth. You need to have like a backup, because all of this, even in the DCF, it's still a lot of assuming. So you just need to think strategically. When there is a counter argument from an investor, you know how to approach it, and therefore like you can play it cool and use different comparables. But obviously, I think as a founder, your valuation, the valuation of your competitors, maybe some indirect competitors too. Investors have actually executed a number of deals and they know how to negotiate, so it can be quite tough, and a lot of investors, they don't do very founder-friendly terms. To be honest, I would say, and it can be a controversial thought, but I would say don't raise if you can't justify a valuation of 3 to 5 million. Why would you give up so much of your company? If it is a pet project, raise on 1 million, whatever. Just don't sell it as a startup. But if you're actually serious to building the next unicorn, you don't want to raise on bad terms in the beginning, because that's death from the start.
Yeah, agreed. Ciaran?
I think it also depends on who the investor you're going to. Like, you should be able to see from their past investments what stakes they take in there for, and therefore what percentage they will be willing to play within. So therefore, based on that percentage, the valuations in which they'll entertain or not entertain. you can obviously reverse engineer it and say, okay, how do I put value on a business that equals that range? But ultimately, a VC is not going to come on board unless they can get a certain slice of the business opportunity. So therefore, it's kind of known what you're going to have to set the valuation to be against that. But yeah, you definitely see a lot of fluctuations between different geographies. The valuations that UK businesses will get within UK VCs are tiny in comparison to the US side of things, and a lot of that is just down to people's ability to quantify valuations in different ways. But equally, they will have higher expectations often how that cash is put to work. But I would just be, a starting point is, if there's a certain fund or VC that you want to work with, look at what amounts they expunge and what they expect in terms of percentage of your business, and that will give you your answer.
Yeah, mins and max, and how much they're going to give you at the end of the day. And then, yeah, as Ciaran said, go retroactive from there. Sean.
Financially and economically, everything which is worth saying, it has been said, so I'm not going to repeat it, but I have 2 points. Number one, do not underestimate how much we are not on the same side of the coin. If you think about your interest and my interest is the exact opposite. You want a big check in exchange for small percentage of the pie. I want a large percentage of the pie in exchange for a teeny tiny check. This is not the same. And many people won't tell you this, but as an insider I can tell you this, VCs play game. A lot of games. They try to undermine your confidence. You say that, oh, you know, my such and such industry metrics, who said that? PwC, 2017, come on, man, come up with something easier. 5 million, I think it's 3 million. We play a lot of games because we want to be in, and we want to be in with a large percentage. And this is the harsh reality. And number 2, and this is a key takeaway, no deal better than a bad deal. You do not want an exit where you end up with £0 in your pocket. You do not want to find yourself in an over-diluted position. If the terms are unacceptable, just leave. Obviously, if you can leave, but that's a whole other conversation for a whole other day.
Love that. I love the fact that you ended on a no deal is better than a bad deal, because as Mariam pointed out, you can go wrong very early on, and if you give away too much or too little, the cap table can look a bit messy towards the end, and once you start raising your Series A, investors will scrutinise your cap table, right? We'll take a look at it, and if it's too messy, they won't go. So, before we get into Q&A, would you mind leaving our founders one piece of advice that they absolutely have to remember when scaling from seed to Series A? You were waiting for me to go. I thought you were going to blurt out the same thing. No, Mariam, please. First thing.
Think about it earlier than you need to. In the sense that these things always get dragged on, so you need to be prepared to raise for much longer than you want to, and you need to start, always be selling, always be fundraising. Maybe it's an obvious one, but I think it's important because then fundraising becomes the only thing that you do because you need cash in order to survive. So you need to have this task force to get the back of your mind.
It was kind of probably to the other question you hadn't asked, but like equity isn't always the solution. There's many other funding instruments out there. Equity would probably be the worst one you can go for. It takes so long, it's a pain in the ass, goes on forever. There's so many variables, so always know other funding options that are available to you. Whether that's in grants or in debt, it's important to know all funding options so you're not beholden to one route.
Yeah, I'm disappointed we didn't get to ask that question actually, because going for debt is often much easier than raising equity. You don't have to give anything away, other than obviously your life, but you don't give away your business. Soma, please. Final thought.
Super brief. 3 things. Number 1, fundraising is a full-time job. Prepare accordingly. Number two, you can survive without VC. You can bootstrap, you can use so many little things. Number three, VCs cannot survive without you. You must invest the money.
I love that.
So always consider your position carefully.
Brilliant. We're falling behind time, but I'm sure that there are questions from the audience. So, yes, please. Persist.
Oh. So my question is, how do you balance narrative and metrics when you negotiate equity percentage, where in the market, traction takes time?
I suppose it depends on what stage you're at. So if you're at the pre-seed stage and you don't have a narrative, what's your unfair advantage? So is your unfair advantage you've got access to a partner which unlocks a big contract, or you have unfair talent, or you've some technology developed? So if you don't have the numbers of attraction, you also need to quantify your competitive edge over someone else, and being able to articulate that is super important.
And just to add to this, I completely agree. If you're in pre-seed, you are pre-money, maybe pre-product, do a really comprehensive market research, because just because you say so, it does not necessarily mean that, okay, there are going to be all those lovely paying customers. However, if you come to me saying that, look, I did the market research, I did 200 customer interviews with these people, I used the mom test, which I do recommend, because if you ask them that, hey, do you have a problem? Yes. Would you pay for it? Yes. This is nothing. This is less than nothing, because this is not strategic questioning, completely misleading data, and to be honest with you, this is rather laughable than any substantial. But if you do, once again, for example, the mom test, and you come to me saying that I know that these people as such and such will pay for it, in fact, I have a letter of intent from such and such, maybe enterprise customer, this is convincing enough. But know your numbers inside and out. That's the best advice I can give you. Maybe you don't have traction, maybe you don't have revenue, but knowing that how much you can grow, the 10 cents soon, so on and so forth, this is absolutely inevitable. And of course, provide us with a good fair deal at the end of the day.
I would say use metrics to build a narrative, because you use the facts, you use what you're building, the real problem, the real numbers, the dry facts, and then obviously use the narrative to make investors and other stakeholders excited, not vice versa, because it's confirmation bias.
You guys briefly mentioned, or talked a little bit about the pitch decks earlier, and I know that we've all spent more than 5 or 10 minutes on LinkedIn, and you've seen Revolut's first pitch deck, Airbnb's. I was just curious, has there been one, let's say recently, that has stuck out to you guys, if you guys have reviewed pitch decks, and what was it that potentially stuck out to you guys?
For me, it's always that I understand early on what the solution is about. Because for example, the decks that I look at, I know that the market is big enough, the team is talented enough, but then what the actual solution is about, and sometimes you have to read the deck 3 times in order to understand what is the actual business model, what is the solution, what kind of technologies, and it's just annoying. So those that are very clear to understand are the ones that actually are my favorite ones.
For me, there is one quality which is always standing out. When you think about fundraising, think about like sales, you need to create urgency. If you can put in your pitch deck that why right now is the opportunity, which the Sequoia pitch deck does it perfectly by recommending you to have a slide with the title right now, this is immediately giving me an urge that, oh my god, this is not for tomorrow, not for yesterday, this is right here and right now. This, in my opinion, the absolute most outstanding quality a pitch deck can have, because if you do it right, guarantee I'm going to give it to the portfolio manager, period.
I can't say I can think of one specifically that blew away. For me, it's always the traction numbers. As Mariam said, quickly understand the business and are they making money and how do they make money, and if I can get that clearly, that's just fair question.
Thank you.
One more question.
Two.
Okay.
So the question about pipeline. If you're investing into new startups, into new kind of fresh pipeline, then where that pipeline comes from, and do you have space for kind of for fresh startups into your pipeline, or is it already been taken by certain communities, institutions, places like where they will raise and so on?
What do you mean by fresh stuff? Sorry,
I think the question is about like
Deal flow.
capacity
Deal flow.
capacity to assess new decks, right?
I think he's saying about
exactly.
your pipeline.
Yeah, your
Yes.
deal
So
flow.
your pipeline for taking on.
He wants you to
Yeah.
invest in him.
No, actually, we are very open. I'm always trying to be creative with the avenues where I discover founders, and they come from very random places, from bars, from gyms, from conferences.
Wherever Mariam goes.
No, but that's true. Or from a friend. Like recently, I reviewed a very cool startup, and that came from my friend from uni, who I haven't seen for 5 years. We randomly met at the birthday party, and I'm like, "Do you have anything medtech?" She was like, "Yeah, sure." And she works at a bank, so that was completely unexpected. So yeah, but I think all the other VCs that I speak up to, because this is where I also get my deal flow. Like we share some of the cool startups. For example, I speak to the VC who invests Series A plus, and we have a strategic fit, like in terms of the technologies or the geographies, and they get to see a pitch deck that is earlier, and they're like, Mariam, you can like check it out and nurture them for me. Maybe it is a fit for you to invest, or like to give non-dilutive, and then we'll pick it up when they grow. So that's like the perfect scenario. And I think all VCs are very open in terms of the deal flow, because the worst, it's not that you invest and you fail, like that startup fails. It's actually okay for a VC investor because power law. The worst is when you miss out on the deal. So actually, I feel like those who are funding, there's like always this anxiety and FOMO to miss out on a good deal. So those who are not open, I wouldn't say they're good VCs.
I suppose ours is slightly different because we've such a broad top of funnel. We're looking to fund across lending, grants, R&D. So we have like maybe doing midweek 350 to 400 businesses, creating accounts every day. So we very much have an open mindset. So it's all about trying to analyze and look at the numbers as quickly as possible to funnel them into different teams. And there'll be people in our R&D division that won't really care what the profit line is, but if they're in certain SIC codes or they're doing certain technology, they want to speed them as quickly as possible. So from our mantra, it's very open focused, open doors.
Yeah, I'm going to be really brief on this, because back when I was in VC, we were really investing a lot, being well connected in the ecosystem. A friend of mine always said that the VC is like a spider in the spider web, because you source things from academia, you source things from incubators, accelerators, from other VCs. We were really lucky because we were working together with 2 amazing scouters, and that's how we had the privilege that every single day we had like 200 or 300 of those pitch decks landing on our table. But this is completely open. I mean, I've never ever seen in my whole life a VC saying that, hey, you wanna send me a pitch deck? You know what? No. I mean, we are really open, because as Mariam said, it's rather the FOMO that we rather review 2,000 in order to find this one instead of reviewing just 200. So deal flow generally, it's just never enough. So if you build a business on this, I think it's a good selling.
Please.
Thank you. So non-VC funding, could you talk a little bit about this, in particular avenues for raising capital against IP, patents, and using them as assets or collateral.
Yeah, there is like debt funding instruments that will do against IP-led funding. You've also got, if you're familiar with the patent box scheme as well, while it's not directly correlated to funding, as soon as you develop a patent, you should get the patent box scheme, because the upside in terms of the reduced corporation tax you'll pay in years to come will pay back in spades. If you are in the IP or patent area, it would correlate to, say, you should be looking at grants. Naturally, grants will be orientated to what the kind of core governance principles at the time. Principally at the moment, it tends to be green energy, AI, supercomputers, quantum are kind of the big drivers. That being said, the Innovate UK Smart Grant Programme is due to come back on in the next couple of months. Essentially, they run every quarter, put about 20 to 25 million into the market. It's not sector agnostic, and usually if you're going as an individual business, you can kind of get up to maybe $250,000, of which 125,000 comes from the grant, and then you match fund the other piece. If you're in the kind of IP or grant orientation, you're naturally going to be investing R&D type things, so you should be getting your R&D tax credits done on an annualized basis, which is cash back into the business until you turn into profit. As soon as you get into a trading methodology, that's obviously when you can start to look at debt instruments. I would say the kind of key figure there is when you get in above 10,000 on a monthly recurring basis, and you do that for 3 months, you're going to have things like revenue-based or merchant cash advance facilities available to you. If you're in a B2B orientation and you land a big contract that have long payment terms, like 90 days, that's when you can start to look at things like selective invoice finance, which you can get advance the cash that up front, or that principle applies to things like R&D tax credits as well. If you're waiting for those credits to come in, you can get that cash advanced to you and pay a percentage until when it gets paid out. As soon as you get into, say, 18 months of trading, then you can kind of get into more traditional term lending type facilities, which can be used to refinance anything you did on the short term. So yeah, a myriad of options depending on kind of your scenario, where you're coming from.
Engineered serendipity. I come from a commercial background, so for me, engineered serendipity is a great way to bump into people that may end up being on your board or being an investor. Is there any scenarios, I think, where you've seen engineered serendipity used effectively? Mariam, you started us off with that, so do you want to take the lead?
Yeah, sure. I mean, I used to be in the origination, and there are different techniques through which you build trust, but I think I'm gonna follow Shomas and be a little bit philosophical to say that if it does, and it sounds very vanilla, but if it doesn't come from your heart, if you're not being sincere about it, and you have very wrong intentions, it's not gonna work out. At least that's what I've believed, and that's what's been working out for me, or not working out if I actually contradicted myself in that sense. I'm gonna leave it at that.
I don't think engineered serendipity necessarily needs to be nefarious. It's not like stalking, although it is kind of like stalking. But stalking with a...
stalk people now with the social media.
Social media, come on. It's like stalk.
So if it's authentic, then all good. If it's nefarious, then no. Ciaran, any thoughts on that as a
more just your last point there in terms of absolutely you can use social media to probably create environments where you might cross paths with an individual that you might be interested in engaging with, but unless you kind of connect on a personal level, it's not going to go much further. So connect on a human level first before going in with any big pitches.
So look and see if they do things like lacrosse or wine tasting or tennis, and then take them up as a hobby. Engineered authenticity. No, I'm only partially joking. Soma.
So actually, let me end on a high note, because I have a really cringy story about that with a guy. He's a US founder in some SaaS thingy, which sadly we invested in and we shouldn't. And he was always bragging about how he actually get pitch meeting with Anderson Horowitz partner, that he followed him to the toilet and just stand next to him And when he was doing his job, he just started like, hey, by the way, I have a startup which I really want to talk to you about. And the guy was just so much in shock that he was like, let me give you my card, just leave me alone, okay? And he actually landed the meeting. So I believe in this stuff. Well, I believe in this stuff. You know, fortune favors the brave, but I'd rather be fan of the age-old saying that early to bed, early to rise, work like hell and advertise. And
thank you very much. I think that was an amazing panel. Lots covered. I hope you can stay for a bit of drinks, and there might be some more questions coming. We've overrun with time, but I think you got quite a lot in terms of the insights. Thank you so much, Soma, Ciaran, Mariam, for the insights. Huge thank you, Greig. Perfect, fantastic moderation. And before, I have a couple of more things, but I just wanted to say that Soma's got 30th birthday today, and he decided that he would like to be with us instead of celebrating somewhere, maybe with friends. So happy birthday, and thank you so much for giving us that evening. Turning you 30 with us. It's, well, once in a lifetime.
I can't imagine a better way to celebrate than I do.
Thank you.